In 2026, cryptocurrency regulations and institutional adoption have reached a turning point. What was once seen as a fringe technology is now deeply integrated into mainstream finance and government policy. From national frameworks in major economies to large financial institutions offering crypto-linked services, this year marks a shift in how digital assets are viewed globally. Regulators are no longer trying to suppress crypto. They are working to understand, shape, and integrate it into existing financial systems. In this video, we will explore crypto regulations and institutional adoption in 2026. If you want to understand how real regulatory changes are shaping institutional involvement in crypto in 2026, stick with this guide. The future of money depends on it. The U.S. regulatory landscape in 2026. In 2026, the United States has taken significant steps toward clearer cryptocurrency regulations. A notable focus has been on enforcing securities laws and defining what qualifies as a security versus a commodity. For instance, regulators such as the U.S. Securities and Exchange Commission (SEC) have pursued enforcement actions and clearer guidance around crypto tokens they consider securities. This has aimed to protect investors while giving markets a framework to operate within. On the flip side, the Commodity Futures Trading Commission (CFTC) has classified major cryptocurrencies like Bitcoin as commodities, expanding its regulatory reach over futures, options, and derivatives. This dual regulatory system has created both challenges and clarity for institutional investors seeking compliance routes. Europe's regulatory framework. MiCA in action. Europe has been a leader in crypto regulation with the rollout of the Markets in Crypto Assets (MiCA) framework. Full implementation began in 2025, and by 2026, MiCA is actively shaping how crypto firms operate across the European Union. MiCA sets clear standards for licensing, consumer protection, stablecoin oversight, and disclosure obligations for digital asset service providers. Unlike more fragmented regulatory systems, MiCA offers harmonized rules across all EU member states. This means a crypto company licensed in one EU country can operate across the Union, benefiting markets and institutional participants alike. European financial institutions are now offering crypto custody, tokenized asset services, and digital securities trading under MiCA compliance. Media coverage from outlets like Reuters and Financial Times provides ongoing updates and expert opinions on MiCA's impact. This framework's clarity is a major reason why institutions are participating more actively in European crypto markets. Singapore's progressive regulatory environment. In Asia, Singapore remains a leading jurisdiction for crypto innovation thanks to its proactive and clear regulatory environment. The Monetary Authority of Singapore, MAS, has adopted balanced guidelines that encourage innovation while imposing due diligence and anti-money laundering (AML) standards. Singapore's Payment Services Act now covers crypto payment tokens and service providers, making it possible for global firms to operate with transparency and regulatory support. Major exchanges and institutions have established offices and custody services there, supported by MAS supervision. Videos and interviews from MAS officials and industry leaders highlight Singapore's role as a hub for digital asset firms, making it a well-documented real case of successful regulation meeting institutional adoption. Cryptocurrency ETFs and institutional entry points. One of the biggest real-world developments in 2026 is the widespread availability of crypto exchange-traded funds, ETFs. In the US and parts of Europe, ETFs for Bitcoin, Ethereum, and major token baskets are now fully regulated and accessible to retail and institutional investors alike. These ETFs allow traditional investment firms and pension funds to gain exposure to digital assets without directly holding them. Institutions that previously feared custody, compliance, and operational risk now have regulated investment vehicles to participate. Financial news channels and investment firms are constantly covering how ETFs have driven fresh capital flows into crypto markets, signaling institutional confidence. Major banks and custodial services. Large financial institutions that were once skeptical of crypto are now providing custodial services, lending platforms, and digital asset trading desks. Institutions such as JP Morgan, Goldman Sachs, and Fidelity have publicly announced, and in many cases launched, crypto custody solutions that comply with local regulations. This provides secure, insured storage for institutional crypto holdings, something regulators and institutional clients have long demanded. These services are widely covered in financial media, including Bloomberg and CNBC video explainers. This institutional infrastructure legitimizes cryptocurrency as a mainstream asset class. Stablecoin regulation and CBDC's regulators are taking stablecoins seriously in 2026 as they become payment rails for global transactions. Governments are introducing guidelines to ensure stablecoins maintain proper reserves, transparency, and liquidity safeguards. The Financial Stability Board, FSB, and G20 have published frameworks to harmonize stablecoin oversight internationally. In parallel, several countries are piloting or launching central bank digital currencies, CBDCs, digital versions of national currencies. China's digital yuan and pilot projects in the EU and Caribbean nations aim to complement stablecoin growth with sovereign digital currencies. This coexistence of regulated stablecoins and CBDCs is shaping a more structured digital payments ecosystem, well documented across news platforms and financial reports. DeFi under regulatory microscope, decentralized finance, DeFi, has grown rapidly, and regulators in 2026 are paying close attention. DeFi protocols offering lending, borrowing, and yield farming are now facing questions about compliance with securities laws and AML standards. Several DeFi platforms voluntarily adopted KYC/AML procedures to align with regulatory expectations. Industry panels, legal experts, and regulators have openly discussed frameworks to bring transparent compliance without stifling innovation. Institutional investment strategies in crypto. Institutional investors are adopting strategies that meet regulatory requirements while capturing crypto's growth potential. Many large hedge funds, endowments, and family offices now allocate a portion of portfolios to regulated crypto products, tokenized assets, or blockchain-linked financial instruments. This shift is publicly confirmed by quarterly investment reports and institutional disclosures. The trend demonstrates that regulated exposure, not speculative trading, is now the dominant institutional crypto narrative. Outro crypto regulations and institutional adoption in 2026 show that digital assets are moving into mainstream financial systems. Clear policy frameworks, regulated investment products, and institutional infrastructure have made crypto accessible, broadly investable, and credible. The narrative is no longer hype. It's real, measurable progress. If you found this breakdown insightful, make sure to subscribe for more crypto and finance content, comment your thoughts below on how regulation will shape the future, and share this video with anyone who wants to understand how digital assets are evolving in 2026.